Hey everyone, there is one question that I've received multiple times. How to build an emergency fund? How much money should be enough for emergency fund and what are the best options to invest for emergency fund? Now emergency fund, as the name suggests, is the fund that can provide financial security in case of an emergency. And we have already seen cases like COVID where many people lost their job. Then off late in 2023, we are hearing a lot about layoffs in the US. Thankfully, the situation in India is not that bad, but emergency fund is something that everyone should build. And generally speaking, your emergency fund should cover around 6 to 9 months of your monthly expenses. For instance, if you have monthly expense of around 50,000 rupee, then you should build an emergency fund of 3 to 4 lakh rupee. Although there is a lot of confusion when it comes to emergency fund. For instance, your stock investment is not an emergency fund. Some people think that they won't need the emergency fund in the near term and end up investing in stocks and equity market to build emergency fund. Please remember this. Don't put money in stock market or equity mutual fund to build an emergency fund. Even the bluest of blue chip stocks don't qualify for emergency fund. The reason is simple. The entire idea behind emergency fund is to ensure that you have enough liquidity to take out that money in case of emergency. So the moment you need money, it should be accessible. And of course, you can't afford volatility with emergency fund. Now, as far as liquidity is concerned, stocks are highly liquid. You can sell your stocks anytime during the trading hours and you will have the money. But the returns are highly volatile in the short term. You don't know if you invested 1 lakh in equity, will it be 1.1 lakh in next 3 months or will it be 90,000 or 80,000? Yes, in the long term, if you invest in fundamentally strong companies and equity mutual fund, then certainly you will see price appreciation. But when I say long term, it has to be more than 5 years. So before you build an emergency fund, remember that it should be highly liquid and should not be volatile. It means your government schemes like PPF, NPS, post office schemes also do not qualify for emergency fund because on one side, while they offer guaranteed return, on another side, they have a lock-in period, which means you can't take out money before a fixed time frame. Another very important parameter to keep in mind is returns. When you want to invest your money that has high liquidity as well as your low volatility, you can't expect high returns. So you have to compromise with return. But ensure that your returns are at par with inflation rate so that your money doesn't shrink. For instance, on an average, the inflation rate in India is around 5%. It means you should ensure that you get at least post-tax annual return of 5% to be at par with inflation rate. Otherwise, you will end up shrinking your money. That leaves us with very limited option, isn't it? So in this video, we'll discuss 4 investment options that you can consider to build an emergency fund that has good liquidity, low to negligible volatility, and returns at par with inflation rate. And the 4th option is probably the most interesting option, but majority of people are not aware of it. So watch this video till the end. Alright, let's get started. So first option to build emergency fund is your saving account. Now saving account is one of the most liquid investment option and has no volatility. But here the problem is that the interest rate on saving account with top tier banks are very low. For example, as of today, SBI saving account interest rate is 2.7%, ICICI Bank and HDFC Bank saving account interest rate is 3%. Now these are the top tier commercial banks of India where you can park your emergency fund without worrying about losing your money. But the problem is very low interest rates. That's where you can consider other commercial banks as well as small finance banks that are currently offering up to 7% interest rates. For example, if you invest between 1 lakh to 10 lakh, Bandhan Bank is offering 6% annual interest, RBL Bank is offering 5.5% interest. Then you have small finance banks like your Suryodaya Small Finance that is offering 6.25% interest, Utkarsh Small Finance that is offering 6.5% interest, and Jana Small Finance is offering 7% interest. Here there is one catch. This interest rate is applicable on investment amount greater than 1 lakh. For example, if you have invested, let's say 2.5 lakh rupee, then for initial 1 lakh, you will fetch a lower interest rate in the range of 4 to 4.25%, and remaining amount of 1.5 lakh will fetch interest in the range of 5.5 to 7%. So let's say you open account with Bandhan Bank and keep 2 lakh rupees emergency fund in that saving account. Now Bandhan Bank is offering 4% interest on investment up to 1 lakh rupee and 6% on amount between 1 to 10 lakh. So you'll end up fetching 4% interest on initial 1 lakh and remaining 1 lakh will fetch 6% interest. So net you will end up with around 5% interest rate. Hope it makes sense. Of course, as the investment amount increases, you will fetch higher interest rate. For example, IDFC First is offering 4% interest on amount below 10 lakh, but if the investment value is greater than 10 lakh, the interest rate is 6.25%. So on an average, you can fetch around 5% interest on your saving account. Of course, the interest rates would vary between bank and your investment amount. Here the most important question is, how safe is it to keep money in small finance banks and other commercial banks like Bandhan Bank, RBL, etc. So you should know that there is a Deposit Insurance and Credit Guarantee Corporation insurance cover that insures your money up to rupees 5 lakh. And all the commercial banks as well as small finance bank fall into the scheme. So in case if the bank fails, your money up to rupees 5 lakh is insured. Moreover, banks don't fall overnight. In case if there is a negative sentiment for a particular bank, you can always withdraw or transfer your money immediately to another account. Although even the money in cooperative bank is insured, but I generally avoid cooperative banks. So number one option to build an emergency fund is saving account. Another benefit of saving account is that there is no tax on interest up to rupees 10,000 under section 80 TTA. So let's say you keep investment amount of 2 lakh in your saving account at interest rate of 5%, then you will fetch annual interest of 10,000 rupee. And this entire amount would be exempted from tax. However, interest above 10,000 rupee will attract tax. And it is cumulative interest we are talking about across all your saving account linked to your PAN card. So if you have 5 saving accounts, then total interest from all the account is tax-free up to rupees 10,000. Hope it makes sense. Overall saving account with small finance bank and commercial bank checks all the 3 parameters of emergency fund. They offer highest liquidity where you can use the money anytime you want, the returns are not volatile, and the interest rate at par with inflation. It's just that your interest won't be able to beat the inflation by a significant margin. Now second option is fixed deposit. Yes, the most traditional and hassle-free option to build an emergency fund. Here again, if you look at each parameter for emergency fund, so first parameter is liquidity. Now when we do FD with a bank, it is for a fixed time period, say 1 year, 2 year, 5 year. But it doesn't mean that you cannot withdraw your money. You can withdraw your money anytime from FD, but it will attract a penalty in the range of 0.5% to 1%. So FD certainly offers liquidity but charges a penalty in case of premature withdrawal. Second, as far as volatility is concerned, FD offers fixed interest, so it is not volatile. Third, as far as returns are concerned, FD interest rates would again vary from bank to bank. Your top tier banks will offer lower interest rate on FD, but of late, since we are in rising interest rate scenario, all the banks have increased their FD rate. For example, currently ICICI Bank and HDFC Bank is offering 6.6% interest on FD between 12 to 15 months period. Then 7% interest on FD more than 15 months. Axis Bank is offering FD up to 7.1%. Federal Bank is offering interest up to 7.25%. IDFC First, Bandhan Bank, RBL are offering FD up to 7.5% interest. And your small finance banks are offering even better FD rates. For example, AU Small Finance is offering FD up to 7.75% interest. Equitas Small Finance FD rate is up to 8% for 888 days. Likewise, some other small finance banks are offering interest up to 8.5%. Of course, the interest rates would vary as per your FD duration. By the way, like I said, your FD is also covered under Deposit Insurance and Credit Guarantee Corporation insurance cover that insures your money up to 5 lakh rupee. So if you have, let's say, 10 lakh to make an FD, you can create 2 FDs with different banks. Here, please note that if you are a senior citizen or about to retire or have a big corpus to park in FD, then invest majority of money with top tier banks so that you can have a peaceful sleep at night. Only a small portion of money is to be kept with other banks and NBFC. The only drawback with FD is that interest earned is completely taxable as per the income tax slab. So if you fetch 7% interest rate, but if you fall under 30% tax bracket, then your post-tax return would be 4.9%, assuming you will not do premature withdrawal. So again, FD offers good liquidity, offers fixed interest rate, and returns are also decent in the range of 6 to 8%. However, the interest is taxable. You can even do FD with top NBFCs like Bajaj Finance and other housing finance companies like LIC Housing Finance. Personally, I would avoid FD with cooperative banks and low-rated NBFCs. Then there is one more interesting option. In case you want to keep your money in saving account as well as in FD, then there is sweep in FD option. Sweep in FD will allow you to invest excess funds lying idle in your saving account in a fixed deposit. So let's say you need 50,000 rupee in your saving account, then you can set up a limit of 50,000 and anything above this amount would be automatically converted into FD. This would give you dual benefit of liquidity from saving account and high interest rates of FD. Just check with your bank if they offer sweep in FD features. Then third option to build emergency fund is debt mutual fund. Now debt mutual fund is a very tricky category. There are more than 10 different type of subcategories like your overnight fund, liquid fund, ultra short duration fund, short duration, medium duration, long duration, corporate bond, banking and PSU debt fund, money market fund, guild fund, and the list goes on. And each debt mutual fund category has multiple debt mutual funds offering from various fund houses. Now each category has a different risk versus reward offering, and you can't blindly opt for any debt mutual fund for building an emergency fund. Here are two important parameters you need to understand before you opt for debt mutual fund. A, duration, and B, credit profile. These two parameters would decide your return versus risk, that is volatility, from debt mutual fund. For instance, a low duration fund will have low volatility, but it would also offer lower return. For example, liquid funds would offer you very low volatility, but their returns are in the range of 5%. Vice versa, long duration debt fund can offer higher returns but comes at higher risk. For example, gilt funds can offer returns in the range of 8 to 9% in the long term, but they are also very volatile. It means in the short term, they can even fetch negative returns. And when you have to build an emergency fund, you can't afford high volatility. Hence, you should opt for low to medium duration debt mutual funds. Earlier, liquid funds were one of my preferred category to build an emergency fund, but the returns are not even able to beat inflation. And second important parameter is to look at debt mutual fund portfolio and understand the credit rating of bonds in that mutual fund. That is the reason I told that debt mutual funds are very tricky. So personally, I prefer three debt mutual fund category to build an emergency fund. First is banking and PSU debt fund, second is money market fund, and third is corporate bond fund. These three categories offer return in the range of 6 to 7% and they are less volatile. Within each category, you need to opt for a specific fund house, and for that, you should ensure that the debt mutual fund has invested in bonds with high credit rating. Personally, I like HDFC Fund House and Kotak Fund House as they have a very good governance structure. Here you also need to consider the taxation part. So if you invest in debt mutual fund and withdraw money within 3 years, you will end up paying taxes as per your income tax slab. However, if you withdraw money after 3 years, you will have to pay tax of 20% with indexation benefit. Here I don't want to get into this detail because I've already explained about debt funds, how it works, taxation, etc. in my course on money management. You can explore it. I've provided the link below. Now, final option to build emergency fund is Bharat Bond ETF. Now, Bharat Bond ETF is one category that majority of people are not aware of. And you can invest in Bharat Bond ETF to build an emergency fund. So in 2019, Indian government launched this nifty Bharat Bond index, and Bharat Bond ETF tracks that index. The best part of Bharat Bond ETF is that it only invests in debt instrument of AAA rated public sector companies and hence has a very low risk profile. The expense ratio for Bharat Bond ETF is 0.0005%, which is almost negligible. And you can buy these Bharat Bond ETF for a minimum amount of 1000 rupee. Currently, this Bharat Bond ETF is offered by Edelweiss Mutual Fund House. Now, as far as liquidity is concerned, you can buy and sell Bharat Bond ETF just like stocks. So there is enough liquidity and the volatility is also very low. Please note that here your returns are not fixed like FD, but it has very low volatility. So you can expect around 7% annual return from Bharat Bond over a period of 1 year. That's the kind of annual return they've provided since inception. Now there are multiple Bharat bonds available in the market with different maturity dates. Some maturing in 2023, some in 2025, 27, 2030 up to 2037. And as duration increases, the yield increases. For example, ETF for 2023 maturity has yield of 7.25%, then it increases to 7.5%, then 7.6%, and 2023 ETF has a yield of 7.6%. However, please note that as the duration increases, your volatility also increases. So you can decide which Bharat bond to buy based on risk versus return. As far as platform for investment in Bharat bond is concerned, you have two options. First is directly via Edelweiss platform and second via your broker. For example, if you want to invest in Bharat bond from Zerodha platform, then you need to search the code as you can see on the screen. Another benefit of Bharat bond is taxation. Similar to debt mutual fund, if you hold Bharat bond for more than 3 years, you have to pay a tax of 20% with indexation benefit. So if you fall in 30% tax bracket, then it is better option than FD. So if I quickly summarize the 4 options to build an emergency fund, first option is saving account with small finance bank and other commercial banks excluding top tier banks. It will offer highest levels of liquidity, fixed returns without any volatility, and returns are in the range of 5%. You also have tax benefit up to rupees 10,000. Second option is fixed deposits with small finance bank and other commercial banks excluding top tier bank. You will have liquidity, but premature withdrawal will attract penalty. Then returns are fixed, so there is no volatility. Returns are in the range of 6 to 7%, but they are taxable as per your income tax slab. Third option is debt mutual fund, where you can consider banking and PSU debt fund, money market fund, and corporate bond fund. They have high liquidity, but returns are not fixed. You can expect return in the range of 6 to 7%. Taxes are 20% with indexation benefit if you hold them for more than 3 years. If less than 3 years, it is taxed as per tax slab. Then fourth option is Bharat bond ETF. It offers high liquidity, but again returns are slightly volatile, and you can expect around 7% return over a period of 1 year. Again, taxes are 20% with indexation benefit if you hold them for more than 3 years. If less than 3 years, then it is as per your tax slab. Now historically, if you see, people would invest their money in gold for emergency purpose because you can sell gold whenever you need money. So there is high liquidity with gold, but the returns are slightly volatile. So today, although you have options to invest in digital gold and the long-term returns are decent in the range of around 8%, but considering the volatility in gold, I would not recommend investing for emergency purpose. You can invest in gold as hedge against equity, where you can invest around 5% of your total wealth in gold. I've created a video in the past where I mentioned that sovereign gold bond is the best option to invest in digital gold. Maybe if you want, I can create a separate video on Bharat bond ETF and digital gold option for 2023. Now tell me, where do you invest your money for emergency purpose? I hope you will find this video useful. I'll see you next video. Till then, take care.